March, June 2024. Question number 3 was on merger and acquisition. And we have to solve this question fully. So I suggest to you, please open this question in your March, June 2024. Open it and read the requirements and the scenario once. Take 5-6 minutes. Then I will be solving it. I need to solve this question. Yes, students, analyze the suitability of P and M company as possible takeover target. To suitability of P and M company as possible takeover target for G company. Okay, so two companies are the suitable target. Then B part is no calculation required for a part A. B part, calculate the minimum price with which P company's shareholders are expected to accept. The target price which G would pay based on free cash flow to equity valuation on the basis of 60% of gains from the acquisition accruing to its shareholders. The percentage gain from the acquisition which would accrue to G company's shareholders if G company paid the minimum price which they are expected to accept based on free cash flows to equity valuation. Okay, we will see. Discuss the feasibility effectiveness of the defense, feasibility and effectiveness of, of, of the defense strategies suggested to fight a takeover bid for P company. So the first part is introduction of G company. So this will help, background information will help us a lot. G company was established 12 years ago to provide courses for accountancy qualification. A major reason for G's success has been that it has been quicker than its competitor to develop profitable e-learning course packages. Apart from the founders, G company staff turnover has been quite rapid. Some staff has not stayed long, either because they are ambitious staff who have made a contribution but sought career progression elsewhere, or because the other reason is they were quickly displaced. G company was listed 3 years ago on the country's stock exchange for smaller companies. It has since developed governance mechanisms in compliance with stock market regulations. Some of its non-executive directors and investor feels that its culture is still too informal for a listed company. Okay. G companies, executive directors are looking to expand the company into new areas of training where there is a potential for cross-selling courses and further opportunities for development of e-learning packages. Granute companies board has identified two possible target companies, P and Shoe company. Two possible targets are there. P company. P company has offered classroom resource courses for legal qualification and professional development courses in area of tax, law, and regulation for over 30 years. P company is also listed on the smaller company stock exchange on which G company is listed. For a long time, P company was a leading company in the area of legal training, and its directors and staff has been in the company for most of its life. The company has well-defined management structure, with the seniority and classroom experience being important attribute required for promotion. Okay. However, in a recent year, revenue and profit growth has been slower than Gernot because of the increased competition. P company failure to develop effective e-learning. Okay. Now, the following financial data relates to the two companies, G company and P company. Number of share price, free cash flow to equity. Additionally, P company's equity beta is 1.4 and asset beta is 1.2. Growth rate in the P company's free cash flow to equity is 1.5% per year. The current risk-free rate is 3.8% and the market risk premium is 8%. G company's finance sector believes that acquisition could generate $9 million of cash flow synergy. The multiple of free cash flow to equity is 8 for Gernot company before the acquisition and can be assumed to be increased by 5% of the combined company if the acquisition takes place. The finance sector believes that P companies shareholder would at minimum accept a premium of 14% and on the current price of share. Although she thinks that the shares may be overvalued in current share price and feels and a free cash flow should be used instead. The board has set a target Gernot company 60% of gain or acquisition accruing to its shareholders. This is the information for the B part. Okay, this is the information on the B part. The minimum price the shareholders are expected to accept. Okay, P company, the minimum price they are expected to accept. Now we will be talking about it. No worries, one by one. Now, so I'm opening Excel sheet and we will be solving it. So you see here the minimum price. So B part is here. The minimum price Pilcher company shareholders are willing to accept So as per finance director, 14% premium on current share price. Okay, so let us calculate. So current share price of Sur company. That is given $5.4. $5.4, it is given. And 14% premium, including price with 14% premium. This is the price per share. This is the price per share. This is the price per share which they are willing to accept. So total market value of shares, total price of share will be this into 100 million shares they have in the million. The first part is done. The first requirement the price they are expected to accept. The target price Gernot will pay based on free cash flow to equity valuation on the basis 60% of the gain accruing to its shareholder. Now, so target price. So now focus. We will talk about. So for this purpose, 60% of gain, we need to calculate total gain. Total gain. And they said that free cash flow to equity model should be used for that. They say that the price is overvalued. Current price. So free cash, the share of P are overvalued. So they should be revalued using free cash flow to equity model. So the second part is the target price they will pay based on free cash flow to equity valuation. Yes, because they say that should be paid through free cash flow to equity model. Free cash flow to equity of Pilser company. How much they are? Just a minute, please. Just 1 second, please. Yes. So that is, we need to calculate 70 million cash flows and equity beta we can calculate. Free cash flow to equity are given 70 million. Yes. $70 million. And then cost of equity we need to calculate. Simple is that. That is, information is given. Information is given. Cost of equity. 1.4 beta equity, risk-free rate, and risk-free premium. So 3.8% plus market risk premium 8% into beta equity 1.4. That is 15% cost of equity. And there is growth rate of cash flows in the P company is 1.5% per year. Growth rate of cash flows. Now we can apply the formula and calculate in the foreseeable future the valuation. So valuation, sorry. So the valuation of Pilser company using equity free cash flow method, that is equal to current cash flows into 1 plus G, it is perpetuity with growth, divided by cost of equity minus G. This is the formula. So this is the answer in millions. Valuation of P company. So second part is done. It is done. Free cash flow to equity. Okay. now Gernud as well. Okay. So now the point is gains based on acquisition. We need to calculate combined company value based on free cash flow. So individual company value. So P company value is done. So Gernud company valuation pre-acquisition. The current value is the current valuation. That is 80 million shares, and each share is of 6. 480 million. These are the current values as said by finance director. Now, if they combined, so combined company, now comes the term of, so that we can calculate gain, value of combined company. So what is happening? They say that, focus, acquisition will generate 9 million of cash flow synergy. Free cash flow multiple is 8 before. So free cash flow multiple for that. That is 8 into 1.05. It will increase by 5% for combined company. This will be free cash flow multiple for combined company. Free cash flow multiple. Now, so free cash flows of combined company. So cash flows of, first of synergy, 9 million, plus cash flows of individual companies, 60 and 70. These are the cash flows of combined company. Cash flows of combined company. Now, value of combined company. So free cash flow multiple is multiplied with free cash flows. They are multiplied to get value of combined company. These both are multiplied. So value of combined company, we have calculated. So what is the additional value created by acquisition? Additional value of synergy. This minus total company, individual values. Value individual. So this is additional value created. Now, now they say the 60% of gain, this will go to whom? Gernud. They said that 60%. 40%. So share of gain for Pilser company. Remaining 40%. 40%. Now, so total value for Pilser company shareholders in combined company, what will be that? This synergy plus this value based on free cash flow to equity. So this is the value they will have in combined company. So market value, so value per share, per existing share. This existing shares are 100 million. This is what we had to calculate. This is what we had to calculate. 5.91 is the B, which is, so this was the required. The target price, this is the target price. Yes, this is the target price they will offer. 5.91 or total value. The target price Garmood would pay based on free cash flow equity valuation, 60% of gain of acquisition accrued to its shareholders. Any confusion in it? Now, the next part is the percentage of gain from acquisition that would accrue to Garmood's shareholders. If Garmood paid minimum price, they are expected to accept now the point is which they are expected to accept. Students, the gain which will be accrued to, read the requirement very carefully. So the percentage gain for Garmood company shareholders, if Garmood pay the price which Pilser company shareholders are expected to accept, which they are expected to accept. Very important. Now, so expected to accept, expected to be acceptable price for Pilsur company. What was that? We calculated above. This is what we calculated. This is what they are expected to accept. So percentage gain. So gain for Garnood company shareholders, if they pay this price, it means total value of combined company, then will be deduct this price. If we pay them this price, less the pre-act price of Garnood. This is the total gain which will go to Garnood company shareholders. So pre-act price. But for the Pilsur company, that price they are expected to pay. This is the gain basically. This is the gain they are going to get. So what is the percentage gain? So 72, they are getting over 480. Yes. Oh, sorry, percentage of gain. So this divided by total gain percentage. So total gain is this additional value. So they will be getting 45%. 72 out of total additional value is 161.3. 44.3%. Percentage share of gain, total gain. If they pay, so the price which is expected to be acceptable, then they get this. Any point you want me to re-explain, do let me know, please. Is that clear? Tell me, is it clear? Any calculation you want to see again? Any response, please? J gain for G company. Yes. Here you go. Value of combined company. Yes. What is C21? It is C27. Value of combined company. Okay, C21. Garnood's pre-acquisition valuation. Pre-acquisition valuation. Welcome. Now, right. So the next point is discuss the feasibility and effectiveness of defense strategy. Okay, what are the defense strategy being discussed? Here there are. So, to fight a takeover bid for P company, P company's directors are aware that Gernot company may be interested in acquiring their company. The directors would not welcome a bid from Gernot as they feel it would result in major changes to how the company operates and threatens their job. Two possible defense strategies have been stressed if Gernot make a bid for the company. One is seeking an alternative, more welcome bidder. Okay. The other is P company making a counter offer to acquire your nude company. So feasibility, the requirement should be focused. The requirement should be focused. Discuss the feasibility. They should do it or not. And then effectiveness. These differences. So first of all is friendly bidder. So Pilsur company, they are trying to buy an alternative bidder. The company is listed in the stock exchange, so the directors should act in the best interest of the shareholders. If they are trying to buy another bidder to protect the interest of shareholders, that is to get higher price, you can note down these points, to get higher price, then it means this is legit. So there, so feasibility and effectiveness. So they are in a specialized business area and listed on a smaller stock exchange. So finding a friendly bidder will not be easier. And there is a fact that, now you see here, we have to link it to the scenario. The company's revenue and growth is slower these years. And which makes this company less appealing for another bidder. So if P company, Pilser company directors, they are unable to find a friendly bidder. It may discourage the shareholders of Pilsur company and will reduce their bargaining position in front for bargaining position of share price in front of Gernot company. Now, so counter, the second is counter bid. So if they are going to counter bid the Gernud company is successful in e-learning. Pilcher company is not e-learning company, but so they have failed to develop e-learning products. This acquisition may be a breakthrough for them. Will help them to move into e-learning. But there are certain challenges in counter bid for that. Gernud company's shareholders will not likely to accept a bid by a less unsuccessful company. Because they are less successful. And you see the whole information is given in the scenario. You can see yourself. And not only by the shareholder, but of the staff of Gernud company will also resist. And the second is the funding issue. That how Pilsur will fund this acquisition if it goes ahead. It is on a shorter stock market, less successful, it may not be able to raise equity. It may not be able to raise equity to finance it, finance this bid. But it need to consider whether they can raise loan. This information is not given about loan. Whether it can raise loan to finance it or not. So it is done for 5 marks. The A part, suitability of P company and M company. We need to see M company. We need to read M company. We have gone through P company, M company. M is an unlisted company which is smaller than Gernul or Pilsur. The company was founded 5 years ago by husband and wife, Richard and Katie, who won 80% of share capital between them. The company provides professional development training in areas such as management and personal skills, also training in legal requirements such as health and safety. Richard and Katie has recruited lecturers whom they feel will work well with them and have given lectures lecturers, considerable autonomy in delivering course and gaining new work. The board considers Richard and Katie and two other lecturers, but in practice, Richard and Katie make all major decisions. Okay. AM's revenue profit have increased in the last 2 years as a greater percentage rate than either by both. AM company has developed a limited number of computer-based courses, but have insufficient funds to have these capabilities. They are growing very good. They have indicated that they are willing to. Now, student, the point is, the requirement is suitability. Whether they are suitable target. Now, so first of all, the business sectors, how they are linked or interlinked or not linked. So Gernot is in e-learning for accountancy courses. And growing. Pilsur is offering in-class courses for law and tax compliance. So Gernot company, its e-learning system can help to transform its courses of Pilsur in e-learning. But the point is, Pilsur company integration may not be easy. As they are working under very well-defined structures. While and they are long employed, but for Gernot, it is not important. Their culture is different. Secondly, M company, Mariu company, it offers professional development courses and personal skills courses which can be offered to existing clients of Gernot company. So, along with the accountancy courses, The packages may be offered of personal skills courses to have a bigger customer base. And since this company is growing, and has culture of growth over there, gaining new work. Based on staff will works like that. They need to gain work as well. So that may be a better outlook, having outlook and culture to be integrated with Gernouth company. There is another aspect. Richard and Katie, they are managing the company by themselves. They would likely to be part of combined company. So this this may be motivating for them as well, because they will be becoming part of bigger organization management. Now, what can be the factor? Suitability. Yes. So one more factor is in the Mariu company, 80% shares are owned by Richard and Katie. Gernouth company can buy the shares of these two shareholders to have a controlling interest over there. While in the case of Pilsur company, in order to get controlling shares, it will be difficult, time consuming to contact and convince so many shareholders. to sell their shares. To sell the shares. So it is complete, students. Now, the next is, the point is, we have to consider the, what was the focus basically? The focus is we have to match and find differences. Match as well and find differences between Pilsur and Gernot. Then Marhu and Gernot. The both as, this is what we have to discuss. Okay, so if you find 2 or 3 points for each company, for Marhu and Gernot and Pilsur and Gernot, the matching. So it is 6 marks complete. Okay, now, so it is done. And of course, that should be scenario specific. If you write scenario specific, that is going to help you ultimately to gain professional marks automatically when you're utilizing that scenario information. Now, so this is done. This question is done. The next question which we need to do is another question related to mergers and acquisitions. That is Propleis company. Propleis company. It is December 2022 past paper, basically. December 2022 past paper. I'll open. So I have decided 3 questions today, which are on the same topic, merger and acquisition, and one question is about reconstruction as well. Okay, this is my target for today. So, December 2022. Here we are. Yes. So please go through this, take 5-7 minutes, then I will be solving it for you. estimate the value of equity, the combination equity value of the combination of Propleis and Adictican, and the benefits of which would be gained by Propleis company shareholder from the acquisition. Discuss the assumptions made in the calculation in A, including whether the expected synergies are likely to be achieved. Okay. And then explain the actions which Propleis company's board can take to ensure the companies are integrated successfully and synergies are realized. So I'm opening an Excel sheet to solve it. So the requirements are in the mind. I've discussed the assumptions and expected synergies. Now, explain the action they will take, they are integrated successfully. Okay, now the reading the scenario. Propleis and A are two listed publishing companies. The main focus of the both companies publishing magazine, although they also publish a limited number of books linked to the magazines. P company publishes property and lifestyle magazine. A publishes magazine covering professional sports. Both companies publish a combination of magazines which have been established in recent years, and some of which have been published for much longer. Propleis company has an in-house team of staff writers and editors who are responsible for content. Most are young and tend to stay for a limited time before moving on to other publishing jobs. A company has a team of in-house writers. You see here, this is the information giving about no synergies, the B part, if I say synergies can be realized or not. A has an in-house writer and editor which each magazine who are specialists in sports, and in some cases they have worked for the magazine many years. Currently successful sports stars are also write for A company's magazine. Now, so currently yeah, they write as well. Senior people. A company's board have given the managerial and writing team of the most successful magazines considerable autonomy in determining the content and development of their magazine. Okay. Now, both companies have an online presence in addition to the publishing paper copies of their magazines. E-companies, electronic subscriber for both companies can access some content which is only available online. Whereas Propolis has won award for its online presence and e-marketing. Yes. A company's website has been criticized for looking old-fashioned, with the main appeal of its online offering being the high quality of content which is made available online. P company is planning to make a takeover bid for A company and have contacted A company's board. P company's board believed that acquisition could provide synergies, particularly in the area of online presence, marketing, yes, cross-selling, and cross-selling means each other customers, and also saving in staff. This is what they are believing sources of synergy, which can be discussed. Acquisition valuation. Yes. The current market value of Propleis company's equity is $620 million and returns equity is $340 million. A company's board has indicated that shareholders will expect a premium of 20% above its equity. Current equity. Propleis company's board feels that shareholders will expect a gain of at least 20% of current equity value of their shares from the acquisition. Okay. Propleis wishes to estimate equity value using a free cash flow to firm method. Using the following information. Expected sales revenue in the first year when the companies are combined $720 million. And an expected growth is from 2 to 4 year, 8%. Expected post-tax operating cash flow in each year, 14% of sale revenue. The company require additional investment in non-current asset of this and $0.3 for every $1 increase in sale revenue in each of the year 2 to 4. After year 4, an expected growth rate of company's free cash flow to firm is 4% for the foreseeable future. Assume a cost of capital of 10%. The target debt equity ratio of combined company is 1:3. Okay. Now, the students, we can start solving it very easily. Come here. We have to calculate value of combined company. Then the synergy benefits have to be allocated. Okay. Then synergy benefits have to be allocated. They have given the equity value of individual companies themselves. We have not to calculate it here. Okay. So we will see. Let us proceed. So first of all, sales. So we have to calculate A part, Propleis company. So year 1, 2, 3, and 4. Yes. Sales. 720 million. Then it will grow at 8%. This into 1.08. 1.08. Sale increase by that. Then they said that post-tax operating cash flows. 14% of sales. So this into 0.14. Now, then they say additional capex required is in the year one is additional capex required. That is how much? 25 million here. And in the next year, $0.3 for $1 increase in revenue. Focus. What is increase in revenue? $0.3 for every $1. This is additional capex required. $0.3 means 30% of each dollar increase in revenue. Yes. This is additional capex. So here are any other costs? Nothing. Any other cash flow? Nothing. Free cash flows to firm. Free cash flow to firm is here. So now 10% cost of capital. So present value at the rate of 10%. This into 1.1 raised to power minus this. Yes, so present value of cash flows at 10% for 4 years. Okay, present value of cash flows, year 1 to 4. Now, afterwards, from year 4 onward, the cash flow will grow 4% in the foreseeable future. Means from year 5. So present value of cash flows from year 5 onwards, it is perpetuity with growth and deferred as well. So first of all, perpetuity with growth. So CF naught into 1 plus growth rate, 4% over 10% cost minus growth rate. This is the present value of cash flows. Next, so this is present value of cash flow from year 5 onward. Year 5 onward. Is there any confusion you can ask? But there is a problem in it. What is that? We have to take, this is starting from year 5. We have to take it to year 0. So 5-year discount factor as well. 4-year. Starting from year 5. So 4-year discount factor will also apply to take it to year 0. Now this is the correct answer. 1265. So market value of combined company. So the sum of these both. Next. Now they have given, this is combined company. These are free cash flow to firm, not equity. So we have got value of firm. So we have to deal with equity. So value of equity, we need to calculate. How to calculate? They have not given us market value of debt, but they have given us the target debt equity is 1:3. So it means 75% is equity. Out of 4, 75% is equity. 75% is equity. So this is 1167.4 million. This is the value of equity of combined company. Is that clear to everyone? Now we can calculate synergy value or additional value created by this combination. This minus equity value of individual companies minus 620 and 340. Additional value created. And they say that 20% premium is payable to above current equity A. Okay. Now, so 20% is payable to them. So 20%. So premium for A company. A company's value is 340 million into 20%. This is what premium they want. So the remaining benefit synergy for synergy value for Propleis company. This minus this. Now, what is the percentage of it? So percentage gain for Propleis company shareholders. This is the gain they are getting. Before they had a value of 620. 620. So they got gain of 22.5%. 22.5% gain. So their expectations were also met. Yes. So we will write it here. We have estimated. So after paying premium of 20% to Adictican company shareholders, Propleis shareholders will get 22.5% gain, which is more than their I want to write a word here. Expectation. Yes. So the calculation of the both equity value of combination done. The benefit gained by the both properly shareholders, that is also done. Both are done. Now, so what are the assumptions? So many assumptions we have used. Okay, let us write down the assumptions. So the second part is discuss the assumption. So it is assumed that sales growth rate, which is 8%. Okay, if 8%. After tax cash flows of 14% of revenue. 14% of revenue. And capital expenditure are reliable estimate. Yes. But there is chance that, a risk that these figures may change and actually may not be the same as being anticipated and estimated. Now, from year 5 onwards, 5 year onwards, what was the growth rate? 4%, I think it was. Yes. 4%. 4% growth of free cash flows is questionable. Free cash flows in perpetuity is questionable. Just a minute, please. As they have to develop online resources and do marketing for Adictican company. Learning material. Now this is again linkage. So these estimates are too simplistic. Too simplistic. Then the last, the cost of capital. The reason for use of 10% and assumption that it will remain same in perpetuity. Perpetuity is doesn't look valid as cost of capital is affected by various factors, including business risk. Now, you see here, whatever you are saying, you have to give some logic for that. Students say it doesn't look same. Why? Now I'm explaining why. This why is very much important. Business risk, capital structure of the company, etc. And these may change with the time. Now, students, the next. Then these two companies integration will have some costs such as redundancy costs, IT integration, cost of employees to avoid duplication, IT systems and development and integration costs. Okay, so these need to be assessed and included in the cash flow projection with care. Now, so the next is synergies. How many marks it bears? Keep that in your mind. The marks. The marks are 6. So 6 valid points. Okay, 1, 2, 3, 4. Now 2 more points about synergies. So synergies, we will give a heading. And we have identified some points. So synergies. Whether they are achievable or not. So some synergies are difficult to achieve. Difficult to achieve. For example, so they are saying synergies are particularly online presence, marketing and cross-selling, and saving in admin, staff, and paper cost. Now, the business, they are sport writers, they are property and lifestyle magazine. So, such as both magazines are different, are having different readership. So, cross selling may not be successful due to interests, different interests of the readers of both magazines, both company. Yes. Yes. Second, their staff is young. Propleis. Secondly, Propleis staff and writers are young and stay for limited time. Yes, Propleis staff is young, while Adictican staff is long term, long term, and and successful senior persons are part of it. So cultural barriers may be there for integration. Staff of both companies may not be easily merged and may show resistance in merged company.